What if the very signs we ignore are the ones that always appear before a major crash? Every time U.S. markets have collapsed in the past, three key signals showed up right before it happened, and right now, those same indicators are flashing again, clearly and dangerously. It happened before the dotcom bubble, before the housing crisis, before 2020's market meltdown. It's happening again. The craziest part? Most investors don't recognize the warning signs until it's too late. So here's the question. Are we on the edge of another financial cliff? More importantly, can we see it before the fall? Drop your thoughts below. Do you think the market is heading for another crash? Yes or no? In this episode of Epoch Report, we're going to break down the 3 red flags that always seem to show up right before every historic market collapse. By the end of this video, you'll have a powerful framework to assess whether the current market rally is a signal of prosperity or the calm before the storm. Stick with us, because what's buried at the end of this story could radically shift how you view risk, timing, and opportunity in the markets. There's a strange thing that happens before every collapse. People feel invincible. The first warning sign is psychological. It's when everyone starts to believe that the market can only go up. Think back to the year 2000. The Nasdaq had risen 7-fold over the previous 9 years. And just when you thought it couldn't go any higher, it doubled again in less than 6 months. At that time, it didn't take any skill to make money in tech stocks. You could close your eyes, throw a dart at a list of internet companies, and still come out ahead. Even the ultra-conservative Federal Reserve Chair, Alan Greenspan, who once called this boom irrational exuberance, later did a complete 180 by early 2000. He started backing the idea of a new economy driven by the internet, suggesting that it was a transformation worth betting on. Cisco became the darling of Wall Street, known for selling the metaphorical shovels of the internet gold rush, routers and networking hardware. Their revenue and profits were surging at breakneck speed. At the time, investors believed there was no reason for stocks like Cisco to ever drop. It felt like the market had become bulletproof. But that illusion is exactly what makes the fall so inevitable. Let's dig into what actually happened after the hype peaked. On March 10, 2000, the Nasdaq reached its all-time high, 5,133 points. Then, something small set off a domino effect. A single negative tech report triggered a 4.1% drop. Soon after, Goldman Sachs released a bearish outlook. Within 1 week, the Nasdaq had dropped by over 8%. Then came the knockout punch. In April, Microsoft faced an antitrust ruling. At the same time, several dot-com companies warned of lower earnings. Leverage accelerated the avalanche. Margin calls and forced liquidations caused a 25% collapse in just 1 week. By May, the Nasdaq had plunged 40%, and it didn't stop there. By October 2002, it had fallen all the way to 1,108 points, a catastrophic drop of nearly 80%. Legendary brands weren't spared. Yahoo crashed from $500 to $8 per share. That's a 93% loss. Cisco dropped by 83%. Dozens of internet stocks disappeared from the market entirely. The lesson: when everyone believes they're safe, even the smallest crack in confidence can cause a total panic. During the height of that bull run, dotcom raised $80 million. The company had a massive advertising budget, even bought a Super Bowl ad spot. Investors were starry-eyed. Retail investors, like a retired teacher who mortgaged her home, rushed in. Then the bubble burst. The company unraveled, and the pet food they'd stockpiled became worthless. This played perfectly into the second major warning sign, FOMO, the fear of missing out. In bull markets, FOMO becomes overpowering. Everyone around you is making big profits. You start to feel anxious. You feel left behind. And to catch up, you chase risky trades, ignore fundamentals, and hold on too long. But here's what ends up happening. Chasing gains leads to bigger losses, often permanent ones. Back in 1999, Warren Buffett stood firm against the tech euphoria. He believed markets had priced in too much hype and not enough reality. Howard Marks made similar warnings, but they were mocked for being out of touch or too old-fashioned. But the data proved them right. Despite being dismissed, Buffett stayed disciplined, focusing on solid, cash-flowing businesses like Coca-Cola and avoiding what he saw as overpriced tech stocks. That mindset helped him avoid the worst of the meltdown. Right now, the S&P 500 is trading at valuation multiples, including PE and price-to-book ratios that are nearing historic highs. Once again, gravity is being ignored. Gravity here is valuation logic, and it always pulls things back eventually. Howard Marks recently compared today's market to wartime readiness, recommending investors dial back aggressive exposure and shift into defensive postures such as bonds. The message from both Marks and Buffett: don't try to time the top, but don't pretend it can't happen either. Let me share this story. Howard Marks once bumped into a man at the gym who bragged about tripling his money on a newly issued stock. The twist? The guy didn't even know what the company did. That's classic FOMO in action. People buying in simply because others made a profit. In reality, the stock market is filled with daily winners and losers. Sure, you'll always find a handful of stocks that jump 20% or more in a day. But catching them consistently is nearly impossible. Buffett refers to this with his baseball theory: you don't have to swing at every pitch. You just need to wait for a pitch you can hit with confidence. During the dotcom frenzy, Buffett ignored the noise and bought timeless companies. He was mocked, but when the storm passed, his portfolio remained intact. Unlike many others, once tech stocks crashed in 2000, attention and money flowed into real estate. By 2004, U.S. home prices surged by 40%. In 2005, another 20%. The frenzy brought in everyone. Even people with no financial background, including nightclub dancers, began buying homes to flip. There were even reports of fictitious marriages created just to gain home buying benefits. Wall Street added gasoline to the fire. By using leverage, subprime loans, and 0% down mortgages, you already know what happened. By 2008, the entire system collapsed. Lehman Brothers vanished. AIG required a government rescue. If Washington hadn't stepped in, we might have faced a repeat of the 1929 Great Depression. What drove all of this? FOMO again. The underlying psychology of these crashes tells us something deeper. There are four main behavioral biases at play. Loss, aversion. The pain of losing money feels stronger than the joy of making it, making people hold losers too long. Social conformity. Humans fear being left out, so they follow the herd, even into danger. Instant gratification. Many can't wait to build wealth slowly. They want it fast. Media amplification. Media love to highlight overnight success stories, reinforcing the illusion that everyone's getting rich but me. As legendary investor Bernard Baruch once warned, when the shoeshine boy gives you stock tips, it's time to get out. The third and final warning always arises in the late stages of a bull market. It's when people start saying, "This time is different." Hear how familiar these sound. 1929. America has entered a period of permanent prosperity. Then the market fell 90%. 1973, blue chip stocks are invincible. Then they got cut in half. 2000, the internet is changing the world. Then NASDAQ dropped 80%. 2007, housing prices never fall. Then came the worst financial crisis in decades. History doesn't repeat perfectly, but patterns do. Mean reversion is not a myth. It's a rule. Here's how that mental model unfolds. 1. A new innovation emerges. AI, crypto, NFTs, you name it. 2. Optimism spreads quickly. Everyone's making money. 3. FOMO kicks in. No one wants to miss out. 4. Overconfidence follows. Institutions, media, even regulators jump in. 5. Then one small problem causes panic, optimism unravels. 6. And finally, post-crash regret. People say, "We got carried away," until years later, when the cycle begins again. If you're still with us, you're not here for fluff or market cheerleading. You're looking for clarity. Here at Epoch Report, we bring clear, honest insights the mainstream often misses or glosses over. Hit the subscribe button and turn on the bell, because in just 10 minutes a day, you'll recognize the signs most people miss, and that can make all the difference to your financial future. So here they are again, the 3 classic red flags. 1. Everyone thinks the market is safe. 2. You feel like it's now or never. FOMO takes over. 3. You hear the phrase, "This time is different." These aren't economic issues, they're emotional traps. Emotional investing often leads to poor outcomes, buying high, selling low, and repeating the cycle. As Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." The real edge lies in thinking differently, resisting the noise, and focusing on fundamentals and discipline. Look at Buffett's portfolio strategy today. Over the last 11 quarters, Berkshire Hathaway has been a net seller of stocks. He's reduced his stake in both Apple and Bank of America. Today, he holds around 32% in cash, only 21% in U.S. equities. The rest? Non-public assets, indicating caution toward public markets. Howard Marks echoes that sentiment, advising a pivot toward defensive assets like short-term U.S. Treasury bonds. Not a total sell-off, but a repositioning. They're not panicking. They're preparing. I want to hear from you. Are these warning signs a ticking time bomb? Or is this just another market cycle that will pass without incident? Leave your take in the comments below. Yes or no? Are we watching history repeat itself? If this breakdown gave you insight, don't just hit like. Subscribe and turn on notifications. Timing matters, especially in markets like these. And the best part? In just 10 minutes a day with Epoch Report, we'll catch the patterns and signals shaping tomorrow's world, long before they hit the headlines.